In November 1910, a group of men boarded a private train in New Jersey. They traveled under false names. They told no one where they were going. They carried no luggage with obvious identifying marks. Their destination was Jekyll Island, a private resort off the coast of Georgia, owned by some of the wealthiest families in America. Among them were Senator Nelson Aldrich, the most powerful Republican in Congress; Frank Vanderlip, president of National City Bank, the most powerful bank in America; Henry Davison's senior partner at J.P. Morgan; Benjamin Strong, future head of the New York Federal Reserve; and Paul Warburg, a partner at the investment bank Kuhn Loeb & Co., who had spent years studying European central banking systems. They stayed on Jekyll Island for 9 days. And in those 9 days, in complete secrecy, they drafted the legislation that would become the Federal Reserve Act of 1913, the document that created the Central Bank of the United States, the institution that controls the interest rates, the money supply, and the financial conditions of the largest economy on earth. To this day, the secrecy was not accidental. As Frank Vanderlip later wrote in his own memoirs, if it was publicly known that our group had got together and written a banking bill, that bill would have had no chance whatsoever of passing Congress, because the American public in 1910 deeply distrusted private bankers. And with good reason. The panic of 1907 had just devastated the economy 3 years earlier. Banks had failed, credit had frozen, businesses had collapsed, and the man who had stepped in to save the financial system was not the government. It was J.P. Morgan himself who had personally organized the private bailout that stopped the panic from becoming a full depression. That episode had demonstrated two things simultaneously. First, that America needed a lender of last resort, an institution that could inject liquidity into the financial system during a crisis. And second, that having a single private banker hold that much power over the economy was deeply uncomfortable for a democratic republic. The solution that emerged from Jekyll Island was elegant in its construction and controversial in its implications. A central bank that would appear to be a government institution, but would be owned, structured, and in significant ways controlled by the private banks it was supposed to regulate. On December 23, 1913, President Woodrow Wilson signed the Federal Reserve Act into law. Many congressmen had already left Washington for Christmas. The vote was rushed. The debate was limited. And the institution that would control American monetary policy for the next century came into existence with remarkably little public scrutiny. Whether that was deliberate or simply convenient depends on who you ask. But the structure that was created that December has shaped every financial decision made in America since. Most people think the Federal Reserve is a government agency. It is not exactly. The Federal Reserve is a hybrid institution unlike anything else in the world. It has elements of a government body and elements of a private corporation simultaneously. Here is how it actually works. The Federal Reserve System consists of a board of governors in Washington, D.C., appointed by the President and confirmed by the Senate. That part does look like a government agency. But underneath the board of governors are 12 regional Federal Reserve banks in New York, Chicago, San Francisco, and 9 other cities. And those regional banks are owned by the private commercial banks in their districts. J.P. Morgan Chase, Bank of America, Citibank, Wells Fargo. They are the shareholders of the Federal Reserve banks. They receive a fixed annual dividend of 6% on their shares, paid every year, guaranteed, regardless of economic conditions. The Federal Reserve does not get its funding from Congress. It funds itself through the interest. It earns on the assets it holds. In 2022 and 2023, the Fed earned over $100 billion in interest income. It remitted the majority of that to the U.S. Treasury. But after paying its own expenses and the dividend to its private bank shareholders first, the most powerful body within the Federal Reserve is the Federal Open Market Committee, the FOMC. This is the committee that sets interest rates. It meets 8 times per year in Washington. Its decisions affect mortgage rates, car loan rates, credit card rates, business borrowing costs, and the exchange rate of the dollar against every other currency. When the FOMC raises interest rates, borrowing becomes more expensive everywhere on Earth. because so much of global finance is priced in dollars or benchmarked against dollar rates. The committee has 12 voting members. 7 are the board of governors appointed by the president. 5 are presidents of regional Federal Reserve banks, rotated among the 12 banks. The president of the New York Fed always has a permanent vote, because New York is where the actual financial operations happen, where the trading desk that implements monetary policy sits, where the relationships with Wall Street's largest institutions are managed daily. That permanent vote for New York means the institution closest to Wall Street always has a seat at the table when interest rates are decided. Whether that represents a conflict of interest or simply a practical necessity is one of the most debated questions in modern economics. What is not debated is the power of those decisions. In March 2022, the FOMC began raising interest rates to fight inflation. Over the following 18 months, it raised rates 11 times, from near zero to 5.5%, the fastest tightening cycle in 40 years. Those decisions increased mortgage payments for millions of American homeowners, raised the cost of every business loan in the country, contributed to the collapse of Silicon Valley Bank and 2 other regional banks in 2023, and triggered financial stress in dozens of countries whose debts were denominated in dollars. All of it decided by 12 people in a room in Washington, 8 times a year, without a public vote, without congressional approval, without a referendum. That is what it means to control monetary policy. And that power was created in 9 days on a private island in Georgia in November 1910. The Federal Reserve was created specifically to prevent financial panics. Its first major test came in 1929. It failed catastrophically, and that failure killed millions of people. Not directly, but through the unemployment, poverty, malnutrition, and despair that follow when an economy collapses and the institution responsible for stabilizing it makes the wrong decision at every critical moment. Here is what the Fed did in 1929 and why it matters. When the stock market crashed in October 1929, the Fed had a choice. It could inject money into the banking system to prevent a credit freeze, or it could allow the market to correct itself, which was the more orthodox economic view at the time. The Fed chose the second option, and then made it worse. Between 1930 and 1933, the Federal Reserve allowed the money supply to contract by roughly 1/3. 1/3 of all the money in circulation simply disappeared. Banks failed and the Fed did not save them. Credit froze and the Fed did not unfreeze it. Depositors lost their savings and the Fed did not intervene. By 1933, nearly 10,000 American banks had failed. 1/3 of all banks that had existed in 1929 were gone. The economist Milton Friedman spent decades documenting this failure. His conclusion, shared by most modern economists, was unambiguous. The Federal Reserve did not cause the crash of 1929, but it turned a recession into the Great Depression through its inaction and its contractionary monetary policy. Ben Bernanke, who later became chairman of the Federal Reserve, gave a speech at Friedman's 90th birthday in 2002. He ended it with these words, addressed directly to Friedman. Regarding the Great Depression, you are right, we did it, we are very sorry, but thanks to you, we won't do it again. 4 years later, Bernanke was running the Fed when the 2008 financial crisis hit. And this time the institution did the opposite of what it had done in 1929. It flooded the financial system with money. It cut interest rates to near zero. It bought trillions of dollars of mortgage bonds and government debt in a program called quantitative easing. Key, that had never been tried at that scale before. The 2008 crisis was severe, but it did not become a depression. Whether that was because of the Fed's actions or despite other factors is still debated by economists. But the contrast with 1929 was deliberate and direct. The institution had learned from its most catastrophic failure, or at least it believed it had. Because in 2021 and 2022, a new debate emerged about whether the Fed had learned the wrong lesson from 2008, whether the decade of near-zero interest rates and quantitative easing that followed the financial crisis had created the very inflation problem that the Fed then had to fight with the most aggressive rate hikes in 40 years. Whether in trying to avoid repeating 1929, the Fed had created the conditions for a different crisis? That question has not been resolved. And it is the question at the center of everything happening in global finance right now. September 15th, 2008. Lehman Brothers filed for bankruptcy. It was the largest bankruptcy in American history. $158 billion in debt, gone overnight. The global financial system went into immediate cardiac arrest. Credit markets froze. Banks stopped lending to each other. The commercial paper market, where companies borrow money to meet daily expenses, collapsed. Within days, companies that had nothing to do with mortgages or investment banking could not access the short-term credit they needed to pay their employees. The Federal Reserve, under Ben Bernanke, responded with a speed and scale that had never been seen before in the history of central banking. Within weeks, it had cut interest rates to near zero. It extended emergency lending to banks, to investment banks, to insurance companies, and eventually to money market funds and commercial paper issuers. It lent money to foreign central banks through swap lines so that banks in Europe and Asia that held dollar-denominated assets could access dollar liquidity without selling those assets into a collapsing market. And then it went further. In November 2008, the Fed announced the first round of quantitative easing. It would buy mortgage-backed securities and government bonds directly, creating new money to purchase assets that no one else wanted to buy. By the time the QE programs ended in 2014, the Fed's balance sheet had expanded from under $1 trillion to over $4 trillion. It had created $4 trillion of new money in 6 years. To put that in context, that was more money than the Fed had created in its entire previous 95 years of existence. The financial crisis was stopped. The banking system survived. But the consequences of that decision took years to fully emerge. Interest rates at near zero for a decade meant that saving money earned almost nothing. It meant that the only way to grow wealth was to invest in assets, in stocks, in real estate. Asset prices surged. The stock market tripled between 2009 and 2019. House prices recovered and then exceeded their pre-crisis peaks. But wages did not keep pace. And the people who owned assets got richer, while the people who did not fell further behind. The wealth gap between the top 10% and everyone else grew wider during the decade of QE than at any point since the 1920s. And then came 2020, the pandemic, and the decision that changed everything again. The Fed cut rates back to zero in March 2020 and launched the largest QE program in history. In the first 3 months of the pandemic, the Fed created $3 trillion, more than it had created in 6 years after 2008. Combined with massive government stimulus spending, that money flooded the economy. And when supply chains broke down and demand surged simultaneously, the result was the highest inflation in 40 years, 7%, 8%. At its peak, over 9% in June 2022. The Fed had spent a decade saying it could not create inflation. Then it created the highest inflation in a generation in 18 months. And the tool it used to fight that inflation, raising interest rates rapidly, caused exactly the kind of financial stress it had spent 15 years trying to prevent. 3 banks failed in 2023. Hundreds of billions in unrealized losses sat on the balance sheets of regional banks across the country. The Fed had saved the system in 2008. But the medicine it used to do it created conditions that required increasingly larger doses to maintain stability. That is the cycle the Federal Reserve is trapped in right now. No president in modern American history has attacked the Federal Reserve as openly and aggressively as Donald Trump, not in his first term, and even more so in his second. In 2019, during his first presidency, Trump called Fed Chairman Jerome Powell an enemy of America on social media. He demanded rate cuts publicly, repeatedly, and with language that no previous president had used. He described the Fed as doing boneheaded things and called Powell a golfer who cannot putt. The attacks were unprecedented, but the Fed did not comply immediately. Powell and the FOMC continued making decisions based on economic data, not presidential preference. In 2025, with his second term underway, Trump escalated. Following the announcement of Liberation Day tariffs in April 2025, Inflation expectations surged and the Fed signaled it would not cut rates while inflation remained elevated. Trump demanded immediate rate cuts to offset the economic impact of his own tariffs. The irony was precise and documented. The president had imposed tariffs that his own central bank said would raise inflation, and then demanded that the central bank cut rates, which would also raise inflation. The two policies were directly contradictory. But the political pressure was real, and it raised a question that goes to the heart of how modern economies are supposed to work. Should the central bank be independent of political control? The argument for independence is straightforward. Politicians have short time horizons. They want low rates and easy money before elections. But easy money causes inflation, and inflation hurts everyone, especially the poor. An independent central bank can make the unpopular decisions that politicians cannot. The argument against independence is equally straightforward. In a democracy, unelected technocrats should not have unchecked power over decisions that affect every person in the country. The people who run the Fed are not elected by anyone. They are appointed through a political process, but insulated from democratic accountability. That tension between democratic control and technocratic independence is not unique to America. It exists in every country with a central bank. But in 2025, with the most powerful economy on earth led by a president openly threatening to fire his central bank chairman, that tension became the most watched financial story in the world. In April 2025, the Supreme Court signaled it might allow Trump to fire Powell. Markets reacted immediately. The dollar fell. Gold surged to new records. Foreign investors reduced their holdings of U.S. Treasury bonds. Because if a president can fire the central bank chairman for making decisions the president disagrees with, the independence of the Fed is effectively over. And a Fed that is not independent is just a printing press controlled by whoever is in power. That is not a theoretical concern. Every country in history that has allowed its government to control its money supply directly has experienced severe inflation. From Weimar Germany in the 1920s to Zimbabwe in the 2000s to Venezuela in the 2010s, the mechanism is always the same. The government needs money. The central bank creates it. Prices rise. The currency loses value. The people who suffer most are those with the least ability to protect themselves. That is the stakes of the battle between Trump and Powell in 2025, not just American monetary policy. The entire post-war model of independent central banking. The Federal Reserve does not just control American monetary policy. Through the dollar's role as the world's reserve currency, the Fed's decisions affect every economy on Earth. And in recent years, the United States has begun using that power not just as an economic tool, but as a geopolitical weapon. Here is how it works. When the Fed raises interest rates, money flows into dollar-denominated assets. Investors around the world sell their local currencies to buy dollars. Those currencies weaken, import costs rise. Inflation in those countries increases. Debt that is denominated in dollars becomes more expensive to service. In 2022 and 2023, as the Fed raised rates aggressively to fight American inflation, the consequences for developing economies were severe. Pakistan faced a balance of payments crisis. Sri Lanka defaulted on its sovereign debt for the first time in history. Egypt, Ghana, and Zambia all required IMF bailouts. Argentina's peso collapsed. None of these countries had caused American inflation. None of them had any control over Fed policy. But all of them paid a price for it. This is what economists call the spillover effect of Fed policy. And it is why the rest of the world watches FOMC meetings as closely as anyone in America. But the weaponization goes further than interest rates. After Russia invaded Ukraine in February 2022, the United States and its allies froze $300 billion of Russian central bank reserves held in Western financial institutions. This was an unprecedented use of the dollar system as a tool of foreign policy. Russia had accumulated those reserves legally over decades. They were frozen by administrative decision, without a court order, without due process. The message to every other country in the world was clear. If you hold your reserves in dollars in U.S. Treasury bonds, in Western financial institutions, Those assets can be seized if your government makes decisions Washington disapproves of. The response was predictable and is still unfolding. Central banks around the world accelerated their purchases of gold. Countries began building alternative payment systems. The BRICS bloc expanded and deepened its work on non-dollar trade infrastructure. The very tool that made the dollar dominant, the trust that dollars held anywhere was safe, was undermined by the decision to weaponize that trust against Russia. Whether that decision was justified by the circumstances is a separate question. The economic consequence is not in dispute. The dollar's share of global reserves has continued its long decline. And the Federal Reserve, which was created to stabilize the American financial system, now finds itself at the center of a global debate about whether the dollar system that it manages is a public good for the world, or a tool of American power projection. That debate will define the next chapter of global finance, and the Federal Reserve will be at the center of every decision that shapes it. This is the question that generates more conspiracy theories than almost any other in finance. And the honest answer is more complicated and more interesting than any conspiracy. Formally, the Federal Reserve is controlled through a clear structure. The President nominates the Board of Governors. The Senate confirms them. The Chairman serves a 4-year term and can be reappointed. Congress can change the Fed's mandate through legislation. The Fed is audited partially by the Government Accountability Office. That is the formal answer. The real answer requires understanding how institutions actually work. The Federal Reserve employs thousands of economists. It has its own research departments, its own models, its own institutional culture. That culture has been built over more than a century. It has views about inflation, about employment, about financial stability that are deeply embedded in how the institution thinks and operates. Individual chairmen come and go. But the institution's intellectual framework persists. And that framework was built in significant part through the influence of the academic economists and the banking community that shaped the Fed's thinking from its earliest days. The New York Fed, in particular, has a relationship with Wall Street that is structural and permanent. The president of the New York Fed is selected by a board that includes representatives of the major banks the New York Fed supervises. The people who rotate between senior positions at Goldman Sachs, J.P. Morgan, and the Federal Reserve are so numerous that the phenomenon has its own name, the revolving door. Timothy Geithner went from president of the New York Fed to Treasury Secretary. William Dudley went from Goldman Sachs chief economist to president of the New York Fed. Dozens of similar examples exist at every level of the institution. This does not mean the Fed does whatever Wall Street wants. The evidence does not support that simple conclusion. The Fed has made decisions that hurt large banks. It has imposed capital requirements they opposed. It has raised rates in ways that reduce bank profits. But it does mean that the worldview of the people who run the Fed is shaped by deep familiarity with how large financial institutions think and operate. And that worldview influences which risks are seen as serious and which are seen as manageable. The risks of inflation tend to be taken very seriously. The risks of inequality, of wage stagnation, of financial exclusion tend to receive less institutional attention. Whether that reflects conscious bias or simply the professional background of the people involved is impossible to say with certainty. What is certain is that the Federal Reserve is not a neutral, technocratic institution operating above politics and beyond influence. It is a human institution shaped by its history, its relationships, and its culture, with enormous power, an accountability that is real but limited, understanding that is not conspiracy thinking. It is the beginning of understanding how financial power actually works in the most important economy on earth. Everything we have covered is not history for its own sake. It is the context you need to understand what is happening to your money right now. In April 2026, the Federal Reserve is facing the most difficult set of conditions it has encountered since the stagflation of the 1970s. Inflation is still above target. The economy is slowing. Tariffs are adding upward pressure on prices while simultaneously reducing growth. That combination, rising prices and falling growth, is called stagflation. And it is the one scenario where the Fed's standard tools do not work. If the Fed cuts rates to stimulate growth, inflation gets worse. If the Fed raises rates to fight inflation, the economic slowdown gets worse. There is no good option, only less bad ones. The last time America faced this combination was under Fed Chairman Paul Volcker in the late 1970s. Volcker's solution was to raise interest rates to nearly 20%. It worked. Inflation was crushed. But it also caused the deepest recession since the Great Depression. Unemployment hit nearly 11%. Entire industries were devastated. The cure was almost as painful as the disease. Whether Jerome Powell, under political pressure from the White House, facing a slowing economy and elevated inflation simultaneously, will have the institutional independence and the political will to make similarly painful decisions is the central question of American economic policy in 2026. And the answer to that question will affect you directly. If the Fed holds rates high to fight inflation, your mortgage costs stay elevated. Business borrowing stays expensive. The job market softens. If the Fed cuts rates under political pressure, inflation may reignite. The purchasing power of every dollar you hold falls further. The savings you have worked for buy less of everything that matters. Either way, the decisions made by 12 people in a room in Washington will shape the financial conditions of your life for the next several years. This is why understanding the Federal Reserve matters. Not as an abstract exercise in economic history, but because the institution created in secrecy on Jekyll Island in 1910 is making decisions right now that will determine whether your savings grow or shrink, whether your mortgage gets cheaper or more expensive, whether the economy you work in expands or contracts. The people making those decisions are not elected. They are not directly accountable to you, but they are accountable to the historical record. And the historical record shows clearly that when central banks get it right, economies prosper and ordinary people benefit. And when they get it wrong, the consequences fall hardest on the people who had the least say in the decision. Understanding that record is not just intellectually interesting. It is practically essential for anyone trying to navigate the financial system that the Federal Reserve built and still controls. Wealth of empires exists to give you that understanding. Subscribe, because the next video continues into the institutions that work alongside the Fed to shape the global financial order. The ones you have never heard of, and the decisions they make that affect you every day.